Jay, always great to have you here. Let's get right into the trading. Tell me, when you look at this environment right now, where do you see the most opportunity with stocks at highs? Everything basically at highs.
Yeah, this is the challenge, right? It's nobody wants to buy at the high. Everybody wants to buy at the low if you have the guts to do it. But when we take a look at the stock market, the S&P, let's say in particular, over the last 9 months, it's starting to form this kind of obscure pattern. It's called the cup and handle. Not everybody follows that pattern, but it kind of forms when the market does a little dip, pulls back, and then dips again, but not nearly as far, and then it eventually pops up. And typically, we don't like to see this V bottom in a cup and handle. We like to see like a smooth base. But, quite frankly, it's starting to stare at us in the face here. Yesterday's breakout led us to believe that maybe this pattern is in play. And if it actually, plays true to what its historical, returns would be, we could be looking at another plus 20 from here. Now, again, it's not the ideal setup, but this kind of cup and handle setup is interesting. I don't know a lot of people talking about it. It might be one of those things that that gives us that technical boost a little higher.
Well, I think when we look at the past 16 months, right, we're now up about 3.5%, I think, roughly from January 2018's high. So it's like when we get to this elevation, I don't know, we get altitude sickness or something, Jane. We drop back down, but you're saying that despite the fact that maybe we got a little trade relief on the moment, I think a lot of people were kind of disappointed in yesterday's move. Are you paying attention to any of that stuff, or are you just saying, look, I'm trying to follow the technicals?
Well, actually, so it's a reason to get long. But for us, Oliver, we always talk about getting long but being hedged when you do it, right? Yeah. Because so many things, we're in the environment where a tweet could kind of reverse the market direction in a heartbeat. And so we always, we'll hedge ourselves, we'll protect ourselves, but we're not against getting long this market, even though you're right. We've bounced off this level a few times, a lot of consolidation at this pricing. Yesterday's breakout was interesting, right? Popped above that level that we've been having trouble getting through. I think we're seeing a little bit of, a gap closing that has to happen against from Friday to Monday. But once we get through that, we don't have a lot of reasons not to be long. Like we're in that, there is no other alternative environment. And so with low rates, investors are forced to take the risk of the stock market. That's unfortunately, it's the truth.
Jay, so let's talk about how to get exposure to the riskier parts of the market, whether it's stocks, whether it's high yield and bonds. I know we've discussed this nature of the trade before. You guys like doing essentially high yield replacement trades. What do you mean by that?
Yeah, so it's, again, as all things, we want to make sure we're protected. We like to hedge ourselves. But, getting long high yield here, that's a very crowded trade, right? I think the HYG is paying something like 5.3% on its dividend, 5.4%, and it's toppy. So how do we get into a position that helps us be protected but still earn that yield? And so what we like to do is we're buying treasuries as kind of the core underneath piece, and then we're selling credit spreads on the HYG. Now, let's just, for practical purposes, let's go out 1 year at a time, because I think the math works out even for everybody. And it's a little complicated, but I'll get through it quickly. Long treasuries, selling, let's say, an 85 by 83 July put spread will generate enough income for you to actually feel like you're earning that 5.3, 5.5% dividend. And the reason why we do that is it does it in a way that I've limited my risk, right? So when I use a spread instead of just being long, I've limited my downside risk. And in this trade here that you see the details on, we're looking to kind of close the gap between what the Treasury pays us and what HYG would pay us by selling premium. The benefits of this trade are that if the market does sell off, if HYG does correct, you're limited to just 3.7% risk once you include the dividends from the treasuries. And so think about this as kind of an HYG replacement. It's one of those ways that when you need to fine tune, the trade to kind of manage your risk in an environment where the trade is really crowded.
I see, and we're looking at sort of an example of the risk profile here for this, though. I'll point out to viewers, as you mentioned, obviously there's a dividend element to this as well. So is this, to you also, Jay, serving the purpose of essentially getting, does it accomplish the same thing as getting long stocks, in the sense that, look, is the environment that's going to be positive stocks will be positive high yield bonds, or is there a possibility that we might have a correction in one versus the other?
Yeah, I mean, this one goes out a full year. Tough to tell where the market's going to go over the next year, of course. So it gives you the benefits of generating the income or the dividends through both the treasuries and the premium selling, but we've managed risk at the same time. Whereas if you just bought HYG stock, you have no protection. If you wanted to go out and protect that position, it's expensive, right? It may cost you 3 of your 5% in dividends just to throw on, an out of the money long put, for example. So, this way allows you to kind of capture the income, but do it in a risk managed way. And if the market drops, you don't really care so much because you've put in that risk level where, you're comfortable with taking only a 3%, 3.7%, level of risk on that trade.
And the real pain only begins if it goes down to 83 anyway, right, Jay? Which means right now at 86, 82, I mean, that's a level that we've only seen during the heat of the December sell-off.
That's right. That's right. And actually, you shouldn't even endure any losses in that put spread until it gets to 85. Okay. So you actually have this little buffer of protection in there that if you were a long stock at this level, you'd take that first 2.5% hit. Here, if it stays above that level, you don't take any hit at all. So, again, it's one of those things where we could recreate the stock position, but with a risk managed profile on it.
Okay, Jay, when you look at equities as well, you've now got a VIX that seems like yesterday there was a hint that this thing would finally break down. I want to get your take generally on the volatility landscape as we flirt with below 14, which, look, a year ago we wouldn't have been making any news about this because we were, a year and a half or so, it was 11, 12, but this is now heading towards the lowest basically since, like 4 or 5 months here for VIX.
Yeah, it was really interesting yesterday. You're right. We saw a gap down in all the volatility index, whether it was the VIX, VXN, or RVX, and it didn't actually reflect what the option chain was showing us. So, of course, the VIX is a mathematical representation of the option chain. But when you actually go to try to sell premium, we're sellers of premium on a monthly basis. If you go out a month, the volatility is even lower than what we saw yesterday. So I think there's a little bit of the remnants of, going into last week of what the higher volatility looks like. I think as we come through Friday, as we get through the jobs number, I think we're really going to see the volatility indexes drop. And so while it's low now, our expectation is it will go lower from here just based on what we're seeing just a few more weeks out in the chain. And so selling premium might start to be a little more difficult for those that, that's a regular process for them.
Interesting. And I should correct myself because we were flirting with 12 right before the May sell-off. Jay, but one thing as well, if we can bring up in our control room TDEX, I like to look at some of the other volatility indexes, one of them from Nation Shares. The Taildex Index shows we've been building up volatility on tail risk type of hedges, Jay, even as VIX has been dropping. And I think that's kind of interesting because that wasn't really the case for a while. So we can see it was dropping off real quickly since the May sell-off, but they're building up again. I mean, is there a possibility that the hedging is starting to occur further out from in anticipation of, look, if there's going to be an event, it's going to be a big one?
Yeah, when we talk about hedging and we talk about, kind of longer dated options, and that really is kind of our bread and butter, right? We are hedgers, long-term investors for our clients. We look at hedging out 1.5, 2 years at a time. There's an interesting dynamic going on with the lower interest rates. And so while most people don't talk about the impact of interest rates on options, if you go out years at a time, you will start to see that options become a much more viable way of putting on protection versus, say, normal diversification that a lot of folks would use with modern portfolio theory. And so, I'm not surprised that index is ticking up because hedging is getting cheaper as rates are dropping. And so if you were to go out farther on the chain and take a look at what's it going to take to put on a protective position, especially if you're using calls as stock replacement, it's actually getting very affordable to do so. Yeah. So I'm not surprised to see that index ticking up a little bit. Not to mention we're at an all-time high, right? So we all know hedging is cheapest when the market is most bullish. All-time highs start to find us in that spot as well.